In today's market, we're seeing investors create massive profits investing in mobile home parks. How are they creating such high profits off such seemingly low rent rates? Is there like a secret that maybe you're not aware of? The answer is yes. In this episode, I'm going to show you how these massive amounts of wealth are being created using a couple different levers that you can utilize too. This is going to open your eyes to another world of real estate that you can't take advantage of if you're flipping homes or wholesaling homes. Stick around because towards the end, I'm going to be showing you how all this comes together and how you can use it to recoup most, if not all of your investment in a really short period of time. It's also going to help you reduce your risk and just boost your returns through the roof. In investment real estate, you really have two main sources of profit. You've got cash flow that comes from rental income, and you've got equity, which comes from appreciation and debt pay down. Think of it kind of like the stock market. You've got dividend stocks and you've got growth stocks. So what you're really looking to do is increase your cash flow and your equity, your appreciation at the same time. If you're too focused on appreciation and not on cash flow, you're going to struggle to float the property. If you're too focused on cash flow and not on growth, you're either not improving the property and maintaining it well enough, or you're maybe buying properties in markets that don't see much appreciation and you're just buying for cash flow. Rental income is important to a property for multiple different reasons. First, it allows you to cover the property's expenses. That way you don't have to write a check every month to own the asset. Secondly, it allows you to pay down the debt. So every month when your tenants pay their rent, they're actually paying down how much you owe on the property too. This allows you to increase your equity in the property throughout the life of ownership, and it's not coming from your pocket to do it. Another great thing about rental income is it's going to limit your risk. If you own a property for, let's say, a 10-year window of time, you may see some fluctuation in the value of that property. If you're having to cover the expenses yourself, you may be put in a position where you need to sell, and you need to sell fast and potentially when the market is down. But when you have cash flow, you're not worried about what the current market value of that property is because you can ride it out and time your exit perfectly. And most importantly, the rental income, the cash flow allows you to live, right? So it gives you return on investment for the entire time that you own the property. Now you're gonna have two forms of return. You're gonna have it during the ownership period, which is that monthly cash flow. And then you're also gonna have it during a capital event, which would be like a refinance or a sale. Equity is the difference between what you've invested or your basis in a deal and what it's worth. Now you can increase your equity in two different ways. You can either reduce how much you have invested in it, which includes paying down debt, but also you can increase it by increasing the value of the property through either organic appreciation or forced appreciation. Some say equity and net worth doesn't matter, and cash flow is the only thing that matters. I've even heard people say the crazy statement of, you can't spend your net worth. You actually can. You could take out a line of credit against the equity in your properties. But it's important to recognize that yes, cash flow is important, but so is equity and your net worth. Net worth is basically the total value of all of your assets, subtract out what you owe against them, and that's the equity, that is your net worth, and that's your wealth. That's the value of everything that you own, and at some point, you're gonna wanna sell that or take advantage of that net worth. Now, what's exciting about net worth and equity is that you can actually grow it faster than the cash flow, and I'm going to show you how here shortly. It's important to recognize the difference between commercial investment grade assets and residential single-family homes. Now, residential single-family homes are valued in a few different ways. Two most common are going to be your comparable sales approach, where you're looking at the different homes around in the neighborhood that are similar to it and what those have sold for. And then you're also looking at the cost to build. And in most cases, you're really not going to look at that. On the commercial side of things, mobile home parks specifically, they're valued based on the cash flow that they produce. All right. So the more income that you can create, net income that you can create, the higher the value of the property. That's super exciting because that means that you can control the value of the property. You're not reliant on what somebody sold their house or their building or their property for down the street. You control it. In order to understand how to value commercial real estate based on the cash flow, you've got to understand this concept of a cap rate. A cap rate is essentially your unlevered return, which means it's the return that you earn each year if you didn't have a mortgage from the cash flow of the property. All right, so let's put this all together and let's use really simple numbers for this example. Let's just say that a mobile home park produces income minus its expenses, creating a net operating income of $1 per month. Okay, take that times 12, which gives you your annual net operating income of $12. We're now gonna take that $12 and we're gonna divide it by the market cap rate, which is basically the return that investors in the market are willing to earn for that location and that property type. Let's just use a crazy number of 10% return. So we would take $12 and we would divide it by 0.10, which is the same as 10%. That's gonna give you a value of $120. So now think about this. You buy a mobile home park that produces $12 a year in net income before your debt, and you paid $120 for it. You're now earning a 10% return on your money. You see how important cash flow really is on these properties now? If you have that dollar per month coming in and you increase that to $2 a month, you've now increased the value of the property by another $120. Well, in commercial investments, you can actually improve the value of the property for every dollar that you add in cash flow. Now, what I want you to recognize here is that the more you improve the quality of the property, the better tenants you're gonna have. And those tenants are gonna pay more in rent, which does what we've talked about. Additionally, the better quality of the asset, the lower return investors are willing to take on that property, meaning they're willing to take a lower cap rate and pay more money for the same dollar that they're earning. This is why you want to subscribe to this channel, because I'm constantly talking about how to actually reposition the properties, make the improvements, increase the cash flow, and in return, increase the value of them. What's awesome about all of this is how simple it is, okay? All your interests are really aligned to create these huge profits. You're focused on increasing the rental income, reducing the expenses, which gives you a higher net operating income. Then you focus on improving the property and taking good care of it, and you get more value, which creates more equity and creates higher net worth. It all comes together. If it didn't get crazy enough and your head hasn't exploded yet, let's take it a step further. Let's say that you're incrementally improving multiple properties over an extended period of time. Let's take that one property that we talked about and increase the net operating income $100 per month. That would improve the property $12,000 in value. But what if that property had 100 units? Do you see how you just added $1.2 million to a property? And then over a period of time, you acquire 10 100 unit buildings, how you'd be creating $12 million in equity? Guys, this is how wealth is built. Hey guys, help me out and drop in the comments below what else you want to know about mobile home park investing in future episodes. Also, hit the like button if this video has helped you see the big picture on how wealth's created in mobile home parks and commercial real estate in general. Now, like I mentioned in the beginning, let's talk about how increasing your cash flow can actually boost your returns and reduce your risk from a little bit different angle. By increasing the cash flow on the property, you're also forcing the value up, and that allows you to go to the bank and refinance the property. You want to recoup as much of your initial investment as possible because the more you recoup, the higher return you earn going forward. On multiple occasions, we've been actually able to recoup all of our investment, which gives us an infinite return going forward. So think about that. We own the property, we have no money invested, and we continue to earn cash flow from it. This strategy, known as the BRRRR method in the residential world, allows you to reinvest the capital to acquire other cash flowing assets, do the same thing over and over and over to scale that portfolio like we talked about. Look, there's nothing wrong with earning large gains using trading strategies like wholesaling or flipping single-family homes. But as you can see, building wealth can be done in ways that may require less risk over time and less transactional work. And best of all, the numbers can get a lot bigger. I'm Mario Datillo, and I'm talking everything mobile home park investing. Check out the next recommended episode that's on the screen.